Hey everyone, welcome back to Corporate Decoder, the place where we sift through corporate filings so you don't have to. Today we're diving into the William Blair Fund's annual report, and let me tell you, there are enough funds in here to make your head spin almost as much as the market does. We are gonna find out which ones are thriving and which ones are just surviving. This report is basically a check-in with all the William Blair mutual funds, seeing how they performed over the last year. It covers everything from investment strategies to fund expenses and even some insights from the management teams. So buckle up because we're about to decode this corporate document. First up, let's talk about the William Blair Growth Fund. Now, this fund, in its Class I shares, saw a return of 22.21%, which is a solid number. A few different share classes are available for this fund: Class I, Class N, and Class R6. However, it underperformed its benchmark, the Russell 3000 Growth Index, which soared by 32.46%. What does this mean? The fund is underperforming the Russell 3000 Growth Index and the S&P 500 due to a bias towards small and mid caps, so a mixed bag, but let's break it down even further. Looking at what worked well, Vital Farms, the egg company, outperformed expectations, as did NVIDIA, the graphics card maker. On the flip side, New Fortress Energy, a natural gas company, and Five Below, a discount retailer, dragged down performance. The report mentions they actually sold their stake in Five Below. Stock picking is a tough job. Now, if you had invested $500,000 10 years ago, how would you have fared? According to the report, the fund would have grown, but lagged behind both the S&P 500 and its benchmark. The S&P 500 would have been a slightly better pick. A few key stats: the fund has almost $250 million in assets, holds 50 different investments, and has a portfolio turnover rate of 49%. The biggest holdings are familiar names like Amazon, Microsoft, and Alphabet. These are names we all hear about daily. Moving on, let's analyze the William Blair Large Cap Growth Fund. This fund has $2.8 billion in assets and focuses on large companies. The fund returned 26.08%, underperforming against the Russell 1000 Growth Index, which gained 33.36%, but it did beat the standard Russell 1000 Index, which returned 24.51%. So while it does beat the broader market, it fails to beat the more targeted Russell 1000 Growth. So what went wrong? According to the management's report, not owning Meta Platforms and Broadcom for most of the year really hurt, and so did their position in Accenture. On the upside, NVIDIA, Apollo Global Management, and ServiceNow contributed positively, and so did underweights to Apple and not owning Adobe. It seems the big swings come from just a few stocks. The key stats show that the portfolio holds only 33 stocks, with top holdings being Microsoft, NVIDIA, and Amazon. It's a concentrated portfolio in those big names. Seems a bit too concentrated for me. Now let's turn our attention to some of the other international funds from William Blair. The William Blair International Leaders Fund had a rough year with negative returns. At minus 0.50%, it definitely underperformed its benchmark. The key issue was stock picking in IT, industrials, and healthcare, and too much exposure to Europe. Some of the biggest detractors were caused by a short position on NVIDIA. In investing, you have to pick your battles, and the manager has decided to take on the biggest winner of the year, NVIDIA. Not a good idea in hindsight. Looking at the numbers, while the past year was tough, the fund has a solid 5 and 10-year history, so there's that. The net assets are around $1.16 billion, and the portfolio includes companies like Taiwan Semiconductor Manufacturing Co. and Hermes International, the luxury goods company. Next, the William Blair China Growth Fund also had an underwhelming year. The fund returned 10.34%, while its benchmark, the MSCI China All Shares Index, jumped 16.38%. The report claims that not having enough exposure to the financials sector and negative picks in IT really hurt them. Not owning the big winners in tech can really destroy the results. With just $1.7 million in assets, it's tiny and has only 45 holdings. Their big bets include Tencent and Kweichow Maodai, the Chinese liquor company. This fund is extremely concentrated in the Chinese economy, very risky. Finally, we will check out the William Blair Emerging Markets Debt Fund. This fund had a great year, returning 9.06%, which outperformed both its benchmark and the broader market. They took on the JP Morgan Emerging Markets Bond Index and beat them. The key to their success, they took on overweight positions in high-risk countries like Ukraine and Argentina. It always pays to bet when everyone else is fearful. It seems it paid off with strong contributions from those investments. On the downside, their picks in Venezuela and Ethiopia didn't work out. They also benefited from underweight positions in China and Saudi Arabia, two very different bets that both paid off. The portfolio's turnover rate is high at 104%. This fund's assets are at $66 million with 245 holdings, which is a very diversified portfolio, and it makes heavy use of derivatives like forward currency contracts and interest rate swaps. That's pretty complex stuff. All things considered, this report is a win. So what do we learn from the William Blair Fund's annual report? The growth fund is having trouble competing in a market dominated by megacap tech stocks. The large cap growth is all in on big tech, and you can see how it affects the fund. The International Leaders Fund's contrarian stance, shorting hot stocks like NVIDIA, is dragging down results and needs to be reevaluated. The China Growth Fund had great intentions but horrible performance. The holdings reflect the macro headwinds in China. Finally, Emerging Markets Debt Fund made a risky bet on very troubled countries. As it turns out, this bet appears to be working for now. Overall, William Blair has a mixed bag. Some funds do great by sticking to a thesis, but the growth and China funds make it difficult to support. Thanks for watching. If you enjoyed, please subscribe, like, and comment.